Well, 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 finally made it to sunny and hot California. That was not the plan. In fact, today seems like the hottest day of the year that they could possibly have in the Bay Area. It's like 90 degrees, 94 degrees here in Larkspur right now. Thank God I'm not staying in Larkspur, I'm over in Tiburon. We literally brought the heat with us from Miami like you wouldn't believe. Every single place that we visited across the country, including up in Illinois, was way hotter than usual, seems like just because we're here. And now finally, by tomorrow, things are gonna cool down and my wish will come true of having a nice, cool place to stay for the summer. And in case you guys don't know, this is my wife, Lizzie. She's walking with me today. She's not going to contribute to the video, she's just hanging out. I want to talk to you guys about adjustable rate mortgages because a lot of people thought this was a good idea back during the GFC, and a lot of people still think it's a good idea today because of where interest rates are at. Well, guess what? A lot of people are starting to get the new bill, so to speak, who got adjustable rate mortgages years ago, talking like 2016 and later. Okay, their mortgages are up for renewal now, where their adjustable rate is going to start to adjust. And where do you think it's going to adjust? It's going to adjust up. That's right. And you know what, when I read this story, I just couldn't help but laugh. And it's not because people's payments are going up, but because the person they talk to in this story, in order to give you an example of how bad this can be and what can happen, they are actually a mortgage broker and they know the risks of what can happen when you get an adjustable rate mortgage. And now this person is looking at maybe a mortgage payment that could be going up by as much as $2,000 a month. Now, for anybody who doesn't know what an adjustable rate mortgage is, it is exactly what it sounds like. You get the mortgage and it's for a fixed rate, usually for 2 years, 3 years, 5 years, something like that. But after that fixed rate period is over, it can adjust to whatever the market rate is. And it's something that a lot of people got in trouble with during the GFC and helped contribute to all the foreclosures that we had. According to the Intercontinental Exchange, there are 1.7 million homeowners that have adjustable rate mortgages who have bought just since 2019. Never mind people who bought before 2019, but just since 2019, right before the pandemic, almost 2 million people have adjustable rate mortgages. And we all know that those people have much lower rates than what anyone is getting today. And therefore lies the problem. According to this data, they say that the adjustable rate mortgages have already reset for 328,000 homeowners so far this year, and there's going to be at least another 102,000 more over the next 12 months. So that's over 400,000 people that are seeing their mortgage rates jump like crazy right now, and their payment could potentially be going to an unsustainable level. And then a lot of people might say, well, how come they didn't just refinance when rates were lower? Great question. Well, maybe they already did. Or maybe they just don't have the equity. Like so many other people, when they buy a house, they borrow against it. They have home equity loans. They have home equity lines of credit. Or they put a very low down payment, which is something that I think is a terrible idea when you buy a house and doesn't give you any equity. Therefore, when you have an opportunity to refinance when the rates are good, now you can't. So having no equity means you also have no options when it comes to your financing. Now, coming back to this woman who is a mortgage broker, okay, who has this adjustable rate mortgage, she forgot that she has a $1.1 million loan on her house, and she has a 10-1 ARM, which means that she actually had a fixed rate for 10 years, which means she had 10 years to potentially build up enough equity or refinance at a more favorable time, but didn't do it. Okay, and now it's time to pay the piper. It's time to refinance or have that rate go up, and she's looking at her payment exploding right now. And here's the crazy thing. This woman, right, she thought that she had this all under control. You know, I'm a mortgage broker, I know what I'm doing. But what ended up happening is she's like, you know, life gets in the way. I have all these kids now, you know, things are happening. And I completely forgot that I have this adjustable rate mortgage on my house. I mean, that's a pretty big error, in my opinion, to kind of forget something like that. That's pretty important. Already last October, we're talking October 2023, her rate went from 2% up to 5.125%, which is the maximum allowed in the first adjustment year, according to her loan terms, which guarantees that it will go even higher the next time it's allowed to adjust, because rates are a lot higher than that right now. Now, here's the thing that you have to understand, that most adjustable rate mortgages do at least come with an interest rate cap to prevent the costs from spiraling out of control. However, you know, hers is capped at 8.125%, which is a whole 5 percentage points higher than what she initially got the loan for. Now, here's the crazy thing. Even though her payment has spiked and the interest rate has spiked, she still has a lower rate than what she would be getting if she had to refinance today. So she's still in a good position in terms of the rate. But the problem is when people don't have the extra money in their budget to actually make that higher payment. Say, you know, you were already stretching it thin when you got the mortgage 10 years ago. So here's what this lady says and how she's handling this, okay? First of all, this coming October, she's looking at another adjustment, right? Because it's once a year that it can adjust, and it's going to adjust even higher, probably not up to the 8% range that it had as the cap, but still, we're still hovering at around 6.8% mortgage rates right now. So it's a guarantee that it's going to go higher than it is right now. And her plan is, well, I'm just going to have to make it work. I'm going to have to figure out how to not stress about this and come up with the money. But not everybody has that option, guys. Like, even then, you know, if you're sitting there contemplating, well, how am I going to come up with the money for something like this, then you're not really an ideal candidate to be taking advantage of an adjustable rate mortgage. If you're somebody that says, okay, let me get the lower rate for now, and then who cares if it goes up to the maximum cap, I'll either refinance by then or I can still afford the payment at that point in time, then fine. But that's not the case for 99% of the people out there. They talked to a loan officer for this story in Massachusetts, and he said that he's also seeing a dramatic increase in the ARM loan applications right now, because a lot of home buyers believe that the Fed is going to cut interest rates in the next few years, and they very well may. However, that doesn't guarantee you, you know, a pass out of the situation. And it doesn't mean that the rate that you get today is going to be lower than what it adjusts to in the future. That's just a guess. You're kind of taking a bet that that's going to happen. There's no guarantees of that. And so the people who are actually taking the bets on this the most right now are the ones who are paying the most for real estate. In fact, anyone who's getting a jumbo loan, which is above a loan that's $766,000 or more, 40% of these people, according to this mortgage broker, are getting ARM mortgages right now, which is adjustable rate, guys. That is insane. That's almost half, okay? So all these people are just taking a giant bet, either because they can afford it and they don't care, or because they can't really afford it and they're hoping and praying that the rates are going to come down, which is most likely the second option. And here's the other funny thing. The woman that we talked about earlier who got the adjustable rate mortgage and forgot about it, who's the loan officer, whenever they interviewed her for this story, they asked her, if you could do it all over again and go back to 2016 when you first got this loan, would you still get the adjustable rate mortgage? And her answer was no. And the reason is because she's still going to end up losing more on this now than if she would have just locked in the 30-year rate back then. Just the fact that your payment goes up so much is also the other problem that people just aren't prepared for, especially when you're someone like this who forgot that the payment is going up. So if you don't know and don't remember that it's going to go up, then you're not prepared for it to go up. That's the problem. Now I want to talk a little bit about inflation, because there is some new data that came out from the European Central Bank. They've been tracking inflation data just like the Fed does, and they lie about it just like the Fed does, just like all the other central banks do across the world. But the interesting thing is they were looking at inflation, and they're saying that, you know, this whole situation in Canada, they lowered the rates, and immediately the inflation, you know, started rising back up over there. And also literally the very next day after Canada cut their rates, inflation in Australia also jumped to the highest level that they've seen so far in 2024. So how is that possible? It's possible because we are no longer separated by borders, guys. We are a global economy now, and these central banks have massive implications and power when it comes to global inflation. And even though the rates might be slightly different everywhere, and we can look at ourselves and pat ourselves on the back here in the US and say, oh, we're doing better than the other countries, clearly, by all the things we've been talking about here in my videos, people are still struggling here too. But it's even worse in places like Canada and Australia. But the reason why this is important is because Canada cut rates, right? And their inflation jumped. Australia's inflation also jumped. And what this is it's an early warning sign for us here in the US in case the Fed cuts rates too early as well. Because they weren't ready for a rate cut, but they cut it anyways. And then now what's happening? Inflation is spiking back up. And this is the blueprint. And it's almost a guarantee that that's what's going to happen here if they cut the interest rates too soon. For anybody who knows this area, I'm shooting this video on Madrone Avenue here in Larkspur, California. And it is quite a bit hotter over here than it was in Tiburon. But I figured, oh, at least we're going to be under the redwoods, and it smells nice and pretty over here, and we're in the shade. So better than being out in the full blast sun. The thing that puts us in the most danger right now is if the Fed gets too many signs that the economy is weakening, then we might be on the table for a premature rate cut as well, which is going to be really bad news for everybody here, because even though the stock market may jump for joy on this, everybody else is going to be suffering because inflation is going to start going back up, and it's going to make life even more expensive than it is now. I know it's hard to imagine that, but yeah, that's where things are going to be headed if we get that premature rate cut. And it's not as if inflation isn't already continuing to go up. It is at the 3.3% rate that we recently got, right? But then it's going to be even worse than that. It might go back up to 4 or beyond. Even the Bank for International Settlements, they released a warning this week about how the central banks need to have a high bar for policy easing, noting that there's a very high risk that looser interest rates could spur price increases. Like, yeah, no kidding. Isn't this your guys' job to know this? How do these people even work at the Fed? How do these guys get appointed there and not know this, guys? This just goes to show you how incompetent everybody is that's running the show right now. You know, they have to be warned by the Bank for International Settlements to know this kind of stuff. This is their job to know this stuff. Because the BIS, they say that a premature easing could reignite inflationary pressures and force a costly policy reversal, all the costlier because credibility would be undermined. Well, if you ask me, their credibility has already been undermined because inflation was supposed to be transitory and it's actually permanent. So that's already the biggest red flag right there, and to me has proven their incompetence at the Fed and has shown that they can't be trusted. And the confidence has already been undermined for people who notice this, like you guys who watch my channel. But most people are just following the Fed's lead, okay? And they are just taking on more debt themselves. You know, we've seen personal debt levels recently rise to all-time highs with credit card debt, with mortgage debt, with car loan debt, with buy now, pay later debt, pretty much any other type of debt you can think of. People are taking on at a higher amount than they ever have before in history. But the economy is great because of it. That's what you have to remember. The economy is great because everybody is taking on that amount of debt, which boosts spending, which boosts profits, which boosts GDP, which makes everything look fantastic when in fact it's horrible. Because there was a recent survey done also from Americans, and 36% of people say that they plan to take on debt in order to travel this summer. Like, how bad does it have to get, guys? Like, how much do people have to lose in order to realize that this is a bad idea? All right, that's what I don't understand. Like, you keep seeing people make the same mistakes over and over. Like, for what? What are you gaining out of this? You're gonna get 10 days on a fun cruise, or, you know, going to Mexico or going to Europe or whatever it is, and then you're gonna be paying for this for the next 5 years because you couldn't afford it? Who needs that? But yet, people are doing it. Like 1/3 of people are doing it. And this is how they break it down, okay? And this is all data according to Bankrate. And they say that the payment methods for summer travel expenses are broken down like this. 5% are taking on personal loans, 8% are taking out buy now, pay later loans, like we just talked about a minute ago, and 6% are actually borrowing money from friends and family because they know someone who's dumb enough to actually give them the money to do all this stuff. If you're somebody in your family or a friend comes to you and you know this person is not great with money and they can't even afford this trip on their own, and they're asking you to borrow money for this, the answer should be no. And if it isn't, and you lose that money and they don't pay you back, then you're getting what you deserve, unfortunately. But it gets better than that, because guess what? A whopping 26% of the breakdown of this expenses is going to come from what? You guessed it, people putting the travel expenses on the credit card. The good old trusty credit card. That's where everybody turns to when they need a little leg up in life. And the reason why this is a problem is not because people are using the credit card to get the points and then just pay off the bill. No, no, no. We're going to put it on the credit card and pay it off over months, maybe years at a time, when interest rates on credit cards are well above 20% and sometimes as high as 30%. So these people who are doing this are absolute fools right now. And you know what, guys? This is a perfect time for me to tell you happy 4th of July, because you're probably going to be watching this video on 4th of July or around it. But I'll tell you what, our founding fathers of this country would be rolling in their graves right now to see how stupid everybody is in this country and the clowns that are running it that is making all of this possible, because none of this was the intention of the people who founded America. So this year it's not Happy Independence Day, it's Happy Dependent on Debt Day, because that's pretty much what everybody is right now. And it's also no surprise that it's mostly the younger generation that's doing this. You know, it's 47% of Gen Zers, 42% of millennials are doing this. So yeah, it's mostly young people that think it's a good idea to put the vacation on the credit card and stuff. And listen, I get it. When you're young, you have to learn things the hard way, and unfortunately, they don't have to. You know, they're going to learn things the hard way out of ignorance, because they probably never saw this video or any others like it, or they're just ignoring it. They're ignoring their elders, like my mom says, right? Because they've been through this before, and they're just saying, no, I'm going to be able to do it better this time. I'll do it different. It's funny because even in this story, they talk to a psychologist, right, to try and determine why anyone would do this, right? That's how dumb this is, that they need to talk to a psychologist to try and figure this out, right? Like, well, why would you take on so much debt at such a high interest rate just to go on vacation? And here's the reasons that people give. Don't laugh yet. This one was really funny. If your kids are dreaming of going to Disney World and there's no way the family could ever really swing it without going into debt, it could be a memory the family will have forever. Yeah, I remember that time when my mom and dad got so far into debt and they fought like crazy and they got divorced. Wasn't that the greatest? But yeah, we had pictures with Mickey Mouse. I mean, the psychology behind this, guys, is even dumber than the behavior, if you ask me. Like, if you really want to give your kids good memories, how about being good parents? How about setting a good example with money? How about showing them and buying them things that you can actually afford? How about not having arguments constantly between you and your spouse to the point where you're getting divorced and you can actually stay together for your kids? I think all that sounds like a much better idea to me. And the problem is parents rationalize this more than anybody else, because they're like, well, I need to give my kids this memory now while they're still young. Otherwise, you know, it's going to be too late when they grow up. Well, if it is too late, you do something else in the future, you know, like, you know, once they get older, you can take them to Universal Studios instead, or Six Flags, somewhere more appropriate for, you know, a teenager or adolescent. You know, you don't have to take them to Disney World, guys. I went to Disney World as a kid, okay? And let me tell you, that's not one of the memories that stands out for me. Like, the things that stand out for me that I remember the most, that actually were the best times, were just my family going out to dinner together. Which, don't get me wrong, still costs money, but it costs nowhere near as much as a vacation to Disney World and paying for hotels and airfare and admission to the parks and all of that stuff you have to pay for. And those are actually the memories that are the fondest in my mind. Even though we did the Disney trip a couple times when I was a kid, it's like, yeah, okay. You know, you only really care about that when you are that young, and when you get older, I don't think you really do. At least it didn't have that much of an impact on me when I got older. Now, one last story I want to get through here, which is kind of funny because I actually made one of my first student loan videos right here on this same street last year in California. And there's a little update on the SAVE program from the Biden administration. Those who have signed up for the SAVE program and have a monthly payment above $0 will not owe anything on their debt for the time being until this whole lawsuit gets worked out, because there's a lawsuit going on with this right now. It's being challenged in court. And so even if you are supposed to be paying something, now it's on hold. And I remember a year ago when I was here talking about this, how they were saying that if you didn't pay after the pause was over, then this would start working against you in the future, and now it's on pause once again. So things are getting so confusing with this that people probably just don't even know what to do anymore. But the whole SAVE program is being challenged in court right now, and that's why the payments are on hold. And so basically, if you haven't heard from them already, the Department of Education will reach out to affected borrowers in the coming days. And those borrowers will have the right to put their loans into forbearance, and they will not accrue interest. So this is once again another example of kicking the can down the road. And actually, the Biden administration is probably happy about this lawsuit and things being challenged in court right now, because it temporarily achieves what they're wanting to do, which is to put these loans on pause or just forgive them altogether. And talk about being another artificial stimulus for the economy. There are 4.5 million borrowers who are enrolled in the SAVE program right now and will have a $0 monthly payment under this program and continue to owe nothing and be considered up to date with their payments according to the Department of Education until this lawsuit gets worked out. And as we all know how lawsuits work, it can take years for this stuff to get settled, guys. So these 4.5 million people who are supposed to be paying $300, $400, $500 towards their student loans right now, instead have to pay zero. And guess what they do with that money instead? They spend it into the economy. They go on vacation. They buy things they can't really afford, making things once again look better than they really are. I mean, it is getting just crazy how many programs and how many things there are out there that are helping people spend money that they don't have right now. But yet everybody looks at this and says, well, this is great. You know, this is the best economy ever, because on paper, the numbers show that it is, and it's because of things like this that it is. But you have to understand that all these programs, all these stimuluses, all these forbearances are temporary, and once they are over and reality comes back into full swing for everybody, that's when we're going to hit a huge wall, and people are going to wake up and realize that this whole great economy that they thought we had has been an illusion all along. So if you enjoyed this video, make sure you subscribe to the channel for my next few months of California videos. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.